Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions and form your own financial conclusions and make your own financial decisions. Today is Wednesday, June 1st, 2022, and this is Blockhead Traders Weekly. In this week's episode, it is just myself, Sprocket888, and we are going to take a look at some potential premium selling plays that I have been looking at recently. The markets have been a little bit of a wreck lately, a tiny bit of sunshine kind of coming through, but nothing to get too excited about yet. But before we hop to this week's episode, I want to give a shout out to our Discord, a link in the description below. It's free to join. Hop in there, say hello to myself, Viper, any of the other Blockhead traders. We would love to hear from you and let us know what kind of content you would like to see. So let's hop to this week's content. In this week's episode, I want to take a look at some potential plays that are out there. We have been in a market slide for quite a while now. And if you've been keeping up with our episodes, you'll know that I have not been doing a lot of trading. A lot of my capital is tied up. I've slowly just been adding deposits to my account on a weekly basis, kind of trying to keep my head above water. I've been de-risking here and there, rolling positions that become challenged and in trouble. And I've really just kind of been towing the line of margin calls, just waiting for my positions to come up. I was in a massive drawdown. A lot of my premium is starting to finally come in. We get a little bit of a swing up and that volatility starts to collapse. The time decay really kicks in. And so I'm starting to get a little bit of life back in a lot of my positions. And I thought I'd take a break from some of the crypto stuff this week. I take a break from some of the lamenting over our market woes and maybe get back to taking a look at a couple of tickers and see, hey, what is out there that might be interesting to play? And what type of things might I be considering entering at these market levels in these market conditions? And I do my screening, as we've mentioned before on this show. I really look for high volume, high volatility, particularly high historical volatility. And what that means is you can have stocks that are just naturally volatile all the time. But what I like to look for is stocks that are abnormally volatile. Okay. And the way that you do that is you look at the historical IV rank or the historical volatility. And what that is it is a percentage from 0 to 100 of on that scale of where this has been over the past year. What percentage are we in? So if most of the year you trade at maybe a 20 volatility level, and then recently you're at a 30, 40, 50 volatility level, you're going to have a very high percentage of volatility, maybe an 80%, 90% volatility, because it means you are higher than 90% of that volatility over the past year. And so I like to screen my plays for that abnormally high volatility relative to the previous trading year. Because with most things in trading, everything is cyclical. So when you are in the lower range of that historical volatility, you can pretty much guess that it is a high tendency that the volatility will increase. When you get to the top of that volatility range, you will find that there is a high probability that the volatility will contract. And whenever we have elevated volatility, premiums are higher. And as an option seller, I like the higher premium. So when I can sell premium on an underlying that is already at its higher volatility levels, it increases my probability of success because likely that volatility is going to come in. And when you sell options, you are effectively selling that premium. I am paying to insure somebody else to take their risk and shoulder it myself. So what kind of stocks do you think I am looking at right now? Ironically, I got a nice trifecta that jumped out at me, which kind of covers a little bit of the gamut when it comes to risk that one might want to take on. And what I found is I'm looking at some soup, some shopping, or maybe some show. That is Campbell's Soup, Shopify, and Netflix. So I've broken these three down. I've taken the same type of play on all three to give a little compare and contrast. And I'll pull up the charts here in a minute. We'll take a look at some of those to see, where are you comfortable at? What makes sense to you? I'll point out some things that I see in the charts. I'll point out some things that I see in the benefit. And I'll mention, if these are trades that I myself would take. So first up is Campbell's Soup. Now, I like this one because Campbell's Soup is a consumer staple, and we are really entering into a lot of inflation uncertainty, a potential economic downturn. Some people are talking about recession, and what does well in that type of environment? Consumer staples. People always have to buy food. There is just some core consumer products that no matter what inflation is at, no matter how much extra expenditure people have, things like that, it's just kind of a core thing that people buy. And Campbell's Soup fits that bill perfectly. Interestingly, with Campbell's Soup right now, is that is a traditionally very low volatile stock. So really hard to sell premium on something that is low volatility because it doesn't move much. You're not collecting a lot of premium because there's not a lot of risk there. Well, right now, Campbell's Soup is actually at 71% IV rank, which means it is a higher volatility right now than 70% of the past year of Campbell's Soup trading. And when I looked at these options, I'm looking at about a 30 delta option, which means there's about a 70% chance of success. And I'm going out to the next available monthly, and that is July monthly, which is roughly 45 days to expiration. And so Campbell's Soup, to sell one put option, because I like to sell put options, the premium, I believe, tends to be better. The markets generally go up. And if you can find a deal where you get an underlying that is a little bit depressed, volatility is elevated, you're just increasing those probabilities of success. So what type of risk do you have to take on for Campbell's Soup? Well, one put option 45 days out is selling for about $1.20 right now. So that's $120 that you'll collect, and you have to put up in buying power $860. Now, this is on a margin account. This is not a cash secured put. A cash secured put would be what it would cost to buy 100 shares of those Campbell's Soup. Adding in the strikes here, you can see that $120 put premium is a $45 strike price on the put. That is roughly a 14% return on my buying power. The next premium selling play I'm looking at here is Netflix. Now, Netflix, as you know, just had a absolutely got obliterated from the most recent earnings where they did not project good growth. They projected that they're having money problems, and the stock was absolutely hammered. And that drove volatility up. It wasn't that long ago that Netflix was trading at over $700 a share. And now we're looking at Netflix under $200 a share. Absolutely crushed. And with that has come some massive volatility expansion. In fact, the volatility on Netflix is at a 67% IV rank, which means over the past year, Netflix is higher now than it has been 67% of the time. So what type of trade can we do? We look at the 30 delta, we're roughly collecting about $8.50 or $850, and we need to put up approximately $3,000 in buying power. It gives us an estimated return on that initial buying power commitment of about 28%. Lastly, one of the more speculative put selling plays, and volatility again just super high, super elevated, is Shopify. Shopify, much like Netflix, absolutely been getting crushed lately. It was not that long ago that Shopify was over $1,700 a share. And now we're looking at Shopify around $350. And if you take a look there, volatility has just climbed and climbed and climbed. So looking at Shopify, we can collect $24 for roughly a 30 delta put. We have to pony up $5,900 in buying power, as it is a pretty beefy underlying and the volatility is very high. However, that returns almost 40% on the buying power allocation. That is a huge premium collection. So what type of stuff are we really looking at there? Like, what do these charts look like? What do I have to say about them? So I am not an expert chart reader, but I do like to look at them. I typically look at them on a daily candles over the past year to give me an idea. I like to plot the 21-day moving average, a 50-day moving average, and a 200-day moving average. So let's take a look at Campbell's Soup. And when we look at Campbell's Soup, what you're going to see here, this is daily candles over the past year, and roughly around March timing, they had some earnings out here. They had a dip on earnings, and look at this run right here from early March all the way up here into mid-May, just a bull tear. And think about that. What was happening in that time frame there? A lot of inflation talk, recession talk, economic downturn talk. And what does well in those type of environments? Those things that I talked about, consumer staples. And what's happened recently is we've had some massive drops off of that, and we're kind of coming back to earth from this really stretched price action here. But if you think that there are tough times ahead for the economy, and you think that these type of consumer staples are going to get more and more money poured into them because there is no better place to go, Campbell's Soup pays about a 3% dividend at its current prices. This is a solid company with solid financials, and it's somewhere that I would pick up some shares at premium here. And so looking here, the 45 strike, which was the 30 delta strike, is still above this 200-day moving average. Yes, we've pulled back. We've pushed down into below the 50-day moving average. However, we did recover, and we're now testing that 50-day moving average again. So it doesn't look super bullish for this, but there are a lot of indicators that say this is a level that might hold. If it doesn't, when I enter these selling put plays, I am okay with share assignment. And with Campbell's Soup, I am okay owning Campbell's. They have a nice 3% annual dividend. It is a consumer staple that does pretty well. And if you look back historically beyond a year, you'll see that this is a relatively stable price level here around that $45 to $50 range. So this is something that I would definitely look at. If we want to take a look at our probability of profit graph, I can go ahead and pull that up. And what we've got here is the profit graph of the 45 strike. And this gray area is basically a 1 standard deviation move based on the current volatility, which is very elevated. You can see that our break even selling here we can go all the way down to 43.85 before we are losing money on this trade. Additionally, your upside, you have significant margin from the current price strike to where your break even is. Sliding over that bar, you can see the probability of profit is about 70%, which makes sense because this is about a 30 delta put. So next up, let's take a look at Netflix. And when we're looking at Netflix, we'll go ahead and we'll look at the profit loss chart here to see where that standard deviation holds. And then we'll remember those numbers as we jump over to the chart. So you can see right now Netflix is trading about $191. This gray area is your 1 standard deviation move of Netflix. Again, this volatility is very elevated. It's about 67% historical volatility. Our break-even point will drop all the way down to about $168 before we lose any money. We're going to collect a good chunk of change on this. And if we take a look at the chart, what do you see? This is what I talked about. Absolutely crushed from the $700 high all the way down. We dipped down and hit a $162 low. We've really bottomed out after that massive earnings miss. There's a large gap here to potentially fill. We're just now crossing above the 21-day moving average. You know, streaming services, they're probably not going anywhere. Is Netflix content good? No, it's not. It sucks. But, you know, that's something that a company could figure out. And the price to earnings ratio here of Netflix has really, really come down. This valuation has really, really come down. And this is somewhere where this implied volatility, this stretched volatility, this is somewhere that I am now comfortable making a play on this. Do I think it's going back to $700? No. But remember, in premium selling, all I'm looking to do is not take a massive dump down from here. It can trade sideways, it can trade up, it can trade slightly down, and I'm going to collect my premium and I'm going to keep my premium. So again, $850 that we can collect here on Netflix at the 30 delta put. So the last chart I want to look at is the Shopify chart. Now, I said this was the most speculative play out there on the set of three, and I really do mean it. This thing, again, absolutely crushed from the highs. 1762 was the high back in November. And look how far we have fallen. We struck a low of $308 just a few weeks ago. So you remember the play here? It's collecting $2,400 in premium for a $6,000 risk. That's a 40% return on the buying power usage. You know, is this thing look like it's ready to turn and head north? No, probably not. But again, remember, we are playing the extended and stretched volatility. And we are just now challenging this 21-day moving average again. We've pushed up to it before and been rejected. A lot of volume is coming into this underlying. You know, is Shopify going to be around for a while? Maybe. But again, this is a 45 days to expiration. I'm playing the volatility. I want to sell it. I'm looking for the contraction. I want the theta decay. And this one is super, super stretched. We take a look at the profit and loss graph here. You can see, again, the gray marks are the one standard deviation move based on the current volatility. It's currently trading around 364. You can see we can come all the way down to $301 before we even start to lose money. Now, remember, the all-time low in the past year was hit a few weeks ago at 308. We're just looking to trade sideways from here and have that volatility contraction. This is absolutely another play that I would definitely get in. So those are the three plays: soup, shop, or show. And they really cover different perspectives on the market. You know, do you think we're heading south more? Do you think we're heading for a recession? You know, Campbell's soup might be something that you want to pick up. Do you think that the streaming company has been battered enough? Do you think it's taken enough licks? You know, maybe you're looking at Netflix and want to capitalize on some of the premium that's there. Do you think that the tech company of Shopify has really gotten hammered enough from the talks of interest rate rises, inflation, all those things, that maybe people are going to still keep spending money? They're going to still keep shopping online. Maybe that is a risk that you're willing to take. They're different sizes. How much of that buying power do you want to take out of your portfolio? Remember, you don't want to bet the whole farm on any of these. You really should be looking at about a 1.5 to maybe 2.5% move based on your entire net lick of your portfolio. So that might help guide which one of these plays is more appropriate for your portfolio size. These are three plays that jumped out to me. These are three plays that I would be willing to take right now. I'm still letting some of my buying power kind of recover, and I'm not quite ready to jump into another trade, but I'm really close to it. And these are definitely things I'm going to be keeping my eye on. Shopify is a little too big for me at the moment. My portfolio really can't handle that amount of buying power allocation to a single position. And so really my choices are between the Campbell's Soup and the Netflix. As much as I really don't care for the Netflix service, this is a trade that I would make in a short-term trade, 45 days to expiration. Let that theta burn off. Absolutely. That brings us to the end of this week's episode. Let us know what you thought of the snapshot on these three underlyings. It's been a while since we did kind of picks of underlyings and kind of compare and contrast different options. Take a look at some of the charts. Maybe this is content you'd like to see. Leave a comment in the video below. Hop in our Discord. Let us know what type of content you want to see. Otherwise, good luck out there. And remember, think outside the block.